My guest Greg MacKinnon of the Pension Real Estate Association explains what REITs are and addresses how investing in them differs from investing in crowdfund real estate deals. Welcome to the National Real Estate Forum podcast, episode 221. Thank you for joining me today. I'm Dr. Adam Gower and this is the nationalrealestateforum.org, where I speak to leaders of the crowdfund real estate industry. Their insights help explain how you can raise capital, build wealth, and earn passive income from crowdfund real estate deals. Today, I'm pleased to announce the launch of a sister website to the National Real Estate Forum at the crowdfundrealestateinvestor.com or CFREinvestor.com. It's dedicated to providing investors with training tools to better understand the deals via the nreforum.org website. And as it's a work in progress, I'm totally open to any thoughts or comments you may have, so please feel free to let me know using the contact page on either website. Again, that new website is crowdfundrealestateinvestor.com or CFREinvestor.com. I get a lot of questions from people asking, how is investing in crowdfund real estate deals any different from investing in a REIT? So to answer this question in detail, I spoke with Greg MacKinnon, who covers research at the Pension Real Estate Association, PREA, P-R-E-A. Greg's perspective comes from his position providing market intelligence to pension funds, of course, to family offices, insurance companies, sovereign wealth funds and other institutional investors. There are links to PREA and to more information about Greg at the show notes to today's episode at nreforum.org/PREA. That's P-R-E-A. I've also included a link on that page to the prior episode that I did, P-R-E-A. I've also included a link on that page to the prior episode that I did with Greg about value investing that is very relevant for crowdfund real estate investors and developers alike in determining where to place their time and capital. Well worth a listen. That's nreforum.org/PREA, P-R-E-A.
Well, I am Director of Research at the Pension Real Estate Association, or what's more popularly known just as PREA by the initials. So as the Director of Research here, my role is basically to provide, research in terms of white papers and data and some sorts of thought leadership to our membership. Our members are institutional investors in commercial real estate. So despite the name of pension real estate, our members include both pension funds, so the big public pension funds and corporate pension funds, but we also include sovereign wealth funds, insurance companies, endowments funds, so the big public pension funds and corporate pension funds, but we also include sovereign wealth funds, insurance companies, endowments, foundations, large institutions that invest in commercial real estate. Our membership also includes the other side of the market, the investment managers that are putting together funds aimed at the institutional investors. So it's an interesting job to be in, sort of in the middle of the market and hearing all the different perspectives.
Do you have any family offices as well?
We do, yes. We do. I mean, our major, and we're global in nature. Majority of our members are based in the U.S. and Canada as well, although we do have members from around the world. But all types of sort of large institutional type investors are our members.
All right, interesting. Okay, so we're going to talk about REITs. Let's start with, what is a REIT? And to what extent are your members involved in REITs?
Well, it's interesting. So if you want to start off just with absolute basics, trust, that's where the name comes from. Essentially, the idea is if someone's not familiar at all with REITs, but they're familiar with, say, mutual funds, equity mutual funds, it's a similar type of idea. In an equity mutual fund, rather than going out and picking individual stocks and buying those stocks yourself, you basically hand your money over to the mutual fund manager in a lump sum, and then the manager goes out and picks a good portfolio for you if it's an actively managed fund. It's a similar idea with REITs. Rather than going out and trying to find particular properties to buy, you invest in a REIT, and the REIT management team is going to then invest in particular properties. Now, what makes REITs different than a mutual fund, however, is that they're publicly traded on a stock exchange. So REITs trade just as any other stock does. If you want to put money into shopping malls, there are a number of REITs that specialize in shopping malls. And similarly, there are REITs that specialize in office buildings, in industrial space, in apartment buildings, all kinds of different things. So really, they're a stock, but the purpose of the company is to invest in commercial real estate of some type. So it's a fairly easy way for someone that's not really well versed in the real estate industry in general to get exposure to real estate. And it's no harder and it costs no more in terms of brokerage fees than buying into any other stock.
In terms of brokerage fees, but what about the fees that the management charge? So, as you know, I've been talking to a lot of crowdfund professionals, and the sense that there appears to be is that in a traditional REIT, the fees are very heavy, that somehow there's an overweighting to fees in REITs. Is that something you can comment on?
Yeah, I mean, it's always difficult to comment exactly on these things because obviously especially.
Is that something you can comment on?
Yeah, I mean, it's always difficult to comment exactly on these things because obviously especially in the crowdfunding area where things maybe aren't quite as standardized yet. It's a relatively new area. In that area, when people are investing sort of directly into real estate via crowdfunding, you have to be careful about the fees because each one's going to be different. So sort of read the fine print is my advice there. For REITs, it's similar. I mean, fees are going to be variable across different REITs, but the easiest way to think about it is because they trade just as stocks. First of all, to actually make the investment, you're going to pay your normal fee you would pay to your broker for any other kind of stock investment, which these days is relatively negligible, especially if you're investing a fair amount of money. If you put your money into a REIT mutual fund, so if you say, I don't want to pick particular REITs, maybe you don't know anything about it, you don't have the time, you can put your money into a REIT mutual fund, then the mutual fund manager is going to charge you a certain fee to be in the fund, Those are similar to regular equity mutual funds. So for a passive index fund based on a REIT index, it's probably going to run about 10 basis points a year, 0.1%. If it's an actively managed REIT fund, the last average I saw was that an actively managed REIT fund where the manager is trying to pick quote, the best REITs, that runs about 53 basis points a year. And so the fee structure, in a sense, is similar to any other stock, investing in any other kind of stock. Now, in terms of how the actual REIT itself is getting paid, it's set up like a regular company, so it gets paid the same way any other kind of regular company does. One thing that some investors will do to get an idea of the kind of implicit fees or costs associated with being in a REIT relative to some direct private market investment in real estate is every REIT, if you look at the financial statements, they're going to have an entry for the general and administrative costs on their income statement. And that basically is the cost of running the organization, right? So all the money they're making from investments in office buildings or malls or warehouses or whatever, some of that money is going to have to actually go to run the company, and that's going to come out in the general administrative cost. That obviously varies from company to company and REIT to REIT, but generally speaking, across all REITs, it runs about 90 basis points a year, give or take a bit. Now, that's obviously going to go up and down over time, and like I said, it varies across REITs. But you're looking at about 90 basis points as the cost of running the company. You throw in, let's say, 10 basis points a year because you're in a passive index fund of REITs because you want to be diversified, and then you're up to about 1% essentially as a total cost, plus any dollar brokerage fees for actually buying the shares if you're buying the shares directly. So it's not necessarily a high cost or a high fee avenue to get at real estate.
Now, when are those fees charged, though? So if I invest $1,000 in a REIT, how are those fees passed through to me?
Generally speaking, in sort of mutual fund speak, if there's an upfront fee to get into the investment, it'd be a front-end load.
Are there any front-end loads going into REITs? Is that how they capture those fees?
No, not generally speaking. I don't want to make a universal statement because there may be some actively managed REIT mutual fund out there that has a front-end load. But as a general rule, no, there's no front-end load nor back-end load like some kinds of funds do either when you take your money out. It's basically showing that if you're in a mutual fund, they're charging you 10 basis points or 20 basis points or whatever each year you're in the mutual fund. Same way that works with any stock mutual fund. The costs of the REIT, sort of running the company, actually sort of directly paying those, That's just money that has to come off the top before you get your profits.
Okay. Before the dividend. Now, in most cases, REITs are income producing. In fact, or in all cases, are they income producing properties that they invest in?
Right, exactly. For a lot of investors, one of the things that makes REITs attractive as a stock, as an equity, is the high dividend yield. So one thing to keep in mind is one of the benefits of the REIT structure in general is that REITs are not subject to corporate income tax on any money they pay out as dividends. So that makes them distinct from a regular old company, General Motors or IBM or something like that. So as long as they pay the money out as dividends to shareholders, they're not subject to corporate tax. So basically they're passing through the profits from the real estate they hold onto the shareholders. What they're subject to, however, to get that benefit, is they are required to pay out at least 90% of their taxable income each year as dividends. So the concept behind them is that they really should be acting kind of as pass-through securities. There's the investors on one side, there's the actual brick and mortars buildings on the other side, and in between are the REITs. And the REITs are running the buildings, they're collecting the rents, they're putting in the capex and that sort of thing. And the money, the profits from those buildings are basically flowing through the REIT tax-free to the shareholders. And if you compare them to regular equities, there is a substantial difference in the dividend yield, which is what makes them attractive to income-seeking investors. So right now, I looked up the numbers a little while ago. Currently, on the NAREIT REIT index, dividend yield's running about 3.8%, and on the S&P 500, it's under 2%. So it's not quite double, but substantially higher. So people looking for fairly steady income on an ongoing basis, REITs are relatively attractive, which is also what attracts a lot of investors to directly buying real estate as well, because they're good income-producing assets.
Okay, and so then typically REITs will invest in what you might call institutional caliber real estate.
Yes, so they're typically investing in quality real estate, although it's interesting in the REIT world, it's most typical for REITs to specialize in one particular type of real estate. So it could be a REIT specializing in shopping malls, in strip center retail, in office buildings, warehouses. There's also a number that specialize in sort of what I call non-traditional types of real estate. So seniors housing, student housing. There's some of the biggest REITs now on the market own cell towers. There's some that own billboards. There's even one or two that own prisons. So there's some of the biggest REITs now on the market own cell towers. There's some that own billboards. There's even one or two that own prisons. So, or manufactured housing is another one. So there's a lot of sort of non-traditional or alternative property types that are now represented in the REIT world. So REITs as a whole are a good way to get access, especially for small investors, to a well-diversified portfolio of commercial real estate. And it's also a good way to get access to some of these types of real estate that no one's going to go out on their own and buy a cell tower probably, but you can invest in a cell tower REIT that owns hundreds of cell towers across the country and is well diversified.
Okay, so this is an interesting way of investing in real estate. One of the ideas that has come up in an earlier podcast was this idea of a liquidity premium, that cell towers and institutional real estate is illiquid, but
certainly all the theory says that when something's more, so REITs are liquid. As you said, you can buy them and sell them at a moment's notice because they trade as stocks do. If you own the underlying real estate, it's obviously much harder to sell an office building on a moment's notice. It's going to take a while. It's going to cost a fair amount of money to actually do the sale. So REITs are more liquid. The theory says that because more liquidity is an advantage, you should get a higher return where there is less liquidity. You don't have that advantage. That's what all the theory says. I know there's all kinds of academics that have been trying to find that liquidity premium for years. No one's actually been able to pin it down and tell how much it is or if it actually exists or not. So certainly liquidity is an advantage. If you don't mind locking up your money for a longer period of time, you may want to look at directly investing in real estate. What happens, though, I think kind of the disadvantage that a lot of people see in REITs relative to directly investing sort of in the private market in real estate is that because REITs trade on the stock market, they are more liquid, but they're also more volatile. So in a sense, as with any stock, the price is going to go up and down each day, each minute, month after month. And sometimes let's call them the animal spirits of the market, get a little carried away. So maybe the REIT prices go up more than they really should. Maybe they go down more than they really should. You do have a lot more volatility in REIT prices than you see in the values of the actual properties that they hold. So that's sort of the downside of the liquidity argument, is because they're in a more liquid market, people are able to buy and sell more quickly, and they do, in fact, buy and sell more quickly, and you get a lot more volatility in REITs than you do in real estate.
So do you get kind of double whammy if the market goes down? Not only does your stock go down, but the dividend also goes down.
Yeah. What happens is that the double whammy comes in because if, let's say, there's a broad market correction in the equity market,
go down, but the dividend also goes down.
Yeah. What happens is that the double whammy comes in because if, let's say, there's a broad market correction in the equity market, sometimes REITs will get dragged down with the rest of the stocks, even if the underlying real estate market looks not too bad. It just sort of, the whims of the market sort of affect it, and the excess volatility comes into play. So you can get sort of double whammied by both movements in the real estate, the underlying real estate market. If that turns down as well, and that affects REITs properties at the same time as the equity market's turning down, you can get a big effect on REITs. And that came out in a big way in the financial crisis back in 2009, I guess now. In the REIT index, I don't have the numbers off the top of my head, but I think the REIT index was down well over 80% at one point.
80%?
Now that was, 80. So it was a big drop in the REIT market. But a lot of that, it turned out, was overblown. I mean, people had just panicked too much. They had driven down the values of REITs far too far. You did see a drop in underlying values of actual properties, but not nearly to that extent. So a lot of that 80% drop was just people getting carried away on the equity market and selling too fast because they were able to sell too fast. The underlying direct private market, real estate market's a lot more sort of slower moving, doesn't react all that much to news on a day-to-day basis, if at all on a day-to-day basis. So the slower moving aspect is bad in the sense that you have less liquidity, but it's good in the sense that you don't have these giant panics that happen one day and then get reversed the next day, like you might have in the REIT market.
So also this idea that if you're a long-term holder, it's not necessarily a good idea to buy REITs, right? Because you are, however it's quantified, you are paying some kind of liquidity premium that if your intent is to hold for the long term, you really don't need to be paying for that.
Yeah, that's certainly a theory for investors that, their allocation to real estate as well as to other private market types of assets is based on this idea that we're able to be very patient capital. We don't need to take capital tomorrow. We can afford to wait years. We can wait out any downturn in the market, and therefore we'll go to the private markets because we expect to get a little bit higher return. The numbers, if you look at the historical numbers, like I said, academics have been trying to sort this out to identify this liquidity premium for years, and as far as I know, no one's actually been able to pin it down yet. So the numbers so far haven't shown that come out. As a matter of fact, REITs over the long term have a somewhat higher return than the corresponding sort of direct market underlying real estate. So the REIT market has done very well. The downside is you had somewhat higher returns, but also with much more volatility over time. So there's more risk in the REIT market with somewhat higher returns. Over the long run, selling them down sort of on a whim, those things will tend to cancel out over time. So over the long run, you do see a fairly high correlation between REITs and direct real estate, because at the end of the day, investing directly in real estate is one avenue to access that kind of investment, and investing in REITs is another avenue to access that kind of investment. And they have somewhat different characteristics, and one may be more advantageous for some investors, and the other may be more advantageous for other investors, but they're both alternative ways to get into real estate. So they both have advantages and disadvantages, is basically what I'm trying to say in a broad kind of way.
Right, and so presumably also investing in a REIT, you have this benefit of diversification as well, right? The REIT manager will be looking at assets across the country and of different characteristics, even within a particular asset class.
Yeah, exactly. And again, it depends on the REIT. Some specialize in certain regions, but generally speaking, you're not buying into
country and of different characteristics, even within a particular asset class.
Yeah, exactly. I mean, again, it depends on the REIT. Some specialize in certain regions, but generally speaking, you're not buying into a single property. You're buying into a REIT that invests in multiple properties, potentially across the country and potentially in multiple countries. So it is certainly an easy way for smaller investors to gain access to a diversified portfolio of real estate, and that's something that for most people they're not going to be able to do with any success in the direct real estate market unless they have a substantial amount of money. Now, that actually is starting to change a little bit. Certainly in the 401k area for retirement savings, there's a number of the larger investment managers that have typically served the institutional investor marketplace that are now launching defined contribution type products suitable for 401ks. So there you put your money into the fund. It's not a REIT, and it doesn't trade on the market. You put it in via your 401k into this fund, and then they basically do the same thing. They take your money and they invest it in a portfolio of properties. So in that sense, you can be diversified in the private market as well.
Ah, right. So explain that a little bit. So these are not REITs, but these are, what is this? These are fund managers, are they? Who are saying, place your money with us, we'll take your money, we'll invest directly in real estate. Is that what they're doing?
In a nutshell, it's exactly what they're doing. So these are not publicly traded REITs. They're typically, as I said, pitched to the 401k market. So you're picking your investments in the 401k, and you can put so much in the fixed income fund and so much in the equity fund. And in some cases, there'll be so much you can put in the direct real estate fund. And you put your money in. They will charge a fee, the same as any kind of fund would. Typically, that runs just under 1% a year. And you are basically in the same kind of fund. You are basically in the same kind of fund. In some cases, it is the same fund as is offered to the large institutional investors. And the idea there is, I mean, if you look at the broad stats for retirement savings in the U.S., the growth area is in defined contribution retirement plans. I believe it was the end of last year was the first year where the total capital in defined contribution exceeded the total capital held by defined benefit plans. So most people are gradually moving to defined contribution plans, and 401ks and the like are becoming more and more important in the marketplace. And investment managers realize that. They can see the writing on the wall that long term that's where the growth is. So they're trying to design products that will appeal to that sector of the market. And what they have to do is they have to adjust their funds in some sense, at least the mechanics of the funds, because to be in a 401k sort of paradigm, you have to be able to funds. Because to be in a 401k sort of paradigm, you have to be able to offer daily pricing. So you have to be able to say every day, here's what the value of the fund is, and you have to be able to offer liquidity because money may be coming in at any time from a 401k investor, and in some cases money might be coming out. So they have a number of mechanisms to take this direct real estate investments, a direct real estate fund that, as we've already said, is typically viewed as an illiquid long-term investment, and make it such that they can tell you each day what the value of those properties are, and they can offer liquidity every day as well. And the liquidity is generally offered by having most of the fund invested in direct real estate, but then a sleeve invested in REITs as well. So if the fund has to come up with X millions of dollars to fund redemptions on a particular day, they can easily sell the REITs to come up with that money. But the 401k providers, before they're going to offer this as an option, on their list of options you can choose from to put your money in, they're obviously going to want to know the details behind all this. And they're going to make sure that they have daily valuation, that there is enough liquidity to fund redemptions and that sort of thing.
For the latest industry updates, get my free crowdfund real estate news digest using the link on today's show notes page at the National Real Estate Forum.org website, nreforum.org/PREA. That's PREA.
Well, what I meant was, though, but if there was a run on it, for example, the market started to go down and everyone said, I want out, put me into treasuries.
Oh, yeah. So if in that kind of case, and that is actually interesting, that's what happened in Germany during the financial crisis. There was a bunch of open-end funds marketed to retail investors in Germany, and in the financial crisis, there were massive runs of those things, and they couldn't come up with the money. The way it's generally handled in this sort of nascent real estate 401k market in the U.S. is they do have this sleeve of REITs and sometimes cash, and sometimes a line of credit with the parent company to fund redemptions up to a certain amount. But most people will say that the best way to put direct real estate into a defined contribution plan is through a target date fund. So a target date fund is one of those funds, and a lot of people have these on their 401k list of choices, where rather than picking where your money goes on your 401k, you just say, I'm going to retire in whatever year, 2045. Okay? And you pick the target date 2045 fund, all your money goes into that, and then the manager of that fund allocates it to equities and bonds and real estate and cash and whatever else. So essentially then you've got sort of a professional asset allocator running the fund, and you don't have these sort of panicky runs on those things.
Oh, you've got somebody in the middle who has common
forming an optimal portfolio. Yeah, well, I mean, everybody has common sense. He certainly has the background to form, what is supposed to be the optimal
not to
portfolio.
Panic like the rest of us.
Exactly.
I see.
Exactly.
All right, so hang on. So let's back up a little and just understand a defined contribution. So this requires that you have a 401k, and a defined contribution is where you decide where you're going to put the money through your 401k. Is that what it is?
Right. The basic difference between the two major types of retirement plans are defined contribution and defined benefit. Defined benefit is the traditional kind of pension plan, where every paycheck, a certain amount gets knocked off, it's taken, but you're guaranteed certain benefits when you retire. Like how much you're going to get. You get some.
Oh, I see. So this is
it's taken, but you're guaranteed certain benefits when you retire. Like how much you're going to get. You get some.
Oh, I see. So this is if you work for
right. Exactly.
If you work for a major corporation or something, or
right, you work for a big corporation or in the public sector. So that's the traditional pension plan, defined benefit. You know what your benefits are going to be when you retire. Mm-hmm. The move is towards defined contribution, where how much you're going to put in. 4% comes off every paycheck and goes into your 401k or something like that, whatever the percent is. So the contribution you're making, but how much you get in the end when you retire, it just depends on how much you put in and how the markets did. So in that case, the risk is on the individual. If the markets tank and you don't have the right investments, then you might get less when you retire. Defined benefit, the risk is all on the employer. Because
they're guaranteeing some kind of result at the end of the day.
Exactly, yeah. So because employers are looking to avoid that risk, there's been a big move towards defined contribution over the years, which is only accelerating.
Ah. So now the burden of deciding where to put that money is falling on the contributor, not the corporation.
That's exactly right. So you have to pick the right investments to fund your retirement. And that's where things like target date funds come in, where the vast majority of people in the world just don't have the time, quite honestly, to sit and decide exactly how to invest their money optimally, because they want to retire in 2045. So you have a target date fund that's specifically for people that are going to retire in that year, and with that length of time left, that time horizon. And then the professional running that target date fund runs their models and decides for someone with that time horizon, X% in stocks, X% in bonds, X%. Thumb is the closer to retirement, the more conservative you want to be.
Right. But that's if the contributor to the plan decides to use one of those fund managers. You can also decide to invest what's in your 401k independently, right? You can select how your money is going to be invested, and one of the things that you were talking about was these real estate funds, right? Where you use the money that's in your 401k and you place it with, I'm not sure what the term is or what they're called, but an investment manager who is investing directly in real estate as a contrast to buying a REIT. So how do those guys work again? Let's just go back to them, because I'm still not quite understanding that. If I decide, all right, I've got 100,000 in my 401k, and I'm going to decide how I'm going to invest that, and I'm going to go to one of these real estate investment fund managers who charges me, you said, a little under 100 basis points a year to invest my money. They're going to invest my money. They're going to aggregate all the contributions that they're able to attract, presumably from people like me, and they're going to go out and buy real estate. Is that what they're doing?
No, that's exactly what they're doing. So they're going to take your $100,000 and my $100,000 and $50,000 from other people. They're pooling it all together and using that to buy a portfolio of real estate. And typically in that market, they're what are called core funds. So it's core real estate, meaning high quality, relatively low risk investments, in quality office property, and generally diversified across all the different property types. So they'll have office, they'll have apartment buildings, industrial space, retail space, sort of all in the same portfolio. So it's a way for an investor, with their retirement savings to get access to, a diversified portfolio of direct real estate.
Is this a new
a diversified portfolio of direct real estate.
Is this a new I want to say asset class, but not asset class. Is this a new type of management fund manager skill set or structure?
It is new in one sense, in that it's only in the last few years that a lot of investment managers have begun looking at this and sort of launching these products tailored to the 401k market. It's not new in another sense in that there's a couple, TIA, for instance, that provides retirement services for teachers. They've had a private real estate fund for, I believe, decades at this point. So that they go way back. They've been doing this for years and years, but only for their particular clientele. Now it's becoming much more widespread. But it's still sort of in the early innings of that market, because a lot of the 401k plan providers are, they're not familiar with this relatively new structure. So, they're making sure that they vet it, they understand it, they see how it works before they start offering it to their plan participants.
And the reason some of these fund managers are targeting 401k clients is because the market is so huge in terms of the dollars.
It's like everything else in life. You follow the money. So the market is huge and it's getting bigger. The traditional defined benefit pension plan, I mean, they're not going anywhere tomorrow. They're going to be around for decades. But it's not a growth area anymore. The defined contribution area is where the growth in retirement savings is. And there's certainly research. Now, I've done research here at PREA with some academic colleagues, looking at the role of real estate, both REITs and direct real estate, in retirement. And there certainly are benefits overall to including real estate in your asset allocation. I mean, we looked in particular at people post-retirement when you're spending, and the big risk when you're post-retirement is basically in running out of money, or what the economists will call the risk of ruin or shortfall probability. So what you don't want to do when you're retired is run out of money. And we sort of looked at using various techniques to look at, could real estate help retirees avoid running out of money? And the results were fairly strong that it could. If you added that to a portfolio instead of just the traditional stocks and bonds, it reduces your risk of running out of money before the end. And it turns out that in most cases, most of the optimal real estate investments include both REITs and direct real estate, because like I said, there are advantages and disadvantages to both.
Interesting. So let me just drill down on one other thought here, just so that I understand. Again, in the back of my mind is how this compares. Obviously, some tremendous differences as well. But so you've got these fund managers who are aggregating 401k money and buying pools of real estate, typically core assets, in order to give yield to those contributors. And the reason that they're focused on 401ks is because this is a huge pool of money in the economy. And then presumably also they're not actually reaching out directly to the contributors. They're reaching out to the corporations and the entities that have tens of thousands of contributors. And then through them, those corporations are making the decisions for the contributors, or they are advising their contributors to consider this kind of real estate investment.
Right. So there's all different kinds of ways that you can, the 401k process can be set up. But basically, there's a 401k administrator at the company or the entity that's offering. The administrator will say, well, here's 25 different funds, and some are equity funds, and some are bond funds, and maybe some are real estate funds, and you guys choose where you want your money to go. In other cases, they're saying, well, we're going to limit your choices and say, sort of limit your choices for your own good, basically, and say, we're going to automatically put you in these different target date funds depending on how long you have to retirement. And sometimes it's a mix of both. We offer the target date fund, but you can pick your own if you want. But they basically present the actual employees, the people who are going to retire at some point, with a list of choices. And they say, your money's going to go into what you choose. Okay? What the investment managers in real estate are trying to do is sort of get on that list of choices. Because in many cases, if any particular person out there on their own 401k at their own particular place of employment, a direct real estate choice might not be available, okay? Because it hasn't sort of been vetted and understood and adopted by that employment. A direct real estate choice might not be available, okay? Because it hasn't sort of been vetted and understood and adopted by that the 401k administrator at their company or their employer. So the key from the industry perspective in real estate is to get real estate offered as one of the choices, and the best way to do that, according to most people, including me, is to make it part of a target date fund. And once it's made part of that, as long as somebody chooses that particular target date fund, a portion, they put, let's say $1,000 into the target date fund, and some portion of that, 10% of it, say, so $100, goes into this direct real estate fund.
Oh, I see.
Now that's targeting this retirement market, okay, where people are putting in 5% of their paycheck every 2 weeks or whatever the case may be. Crowdfunding is sort of a somewhat different kettle of fish, in that if you're not investing for your retirement, you're investing money right now. And you're not saving it for 60 years. You're looking to make profits now. There isn't that many ways to directly invest in real estate, unless you happen to know someone who knows somebody who's selling the 4-unit apartment building down the road. So crowdfunding opens a way for smaller investors to make investments in direct real estate, outside of the retirement planning kind of industry.
But you could do it within the retirement plan as well, though, couldn't you? Can you use your 401k money to invest in equity crowdfunding, for example?
Yeah, I will say right now I'm not a tax attorney or a retirement planning expert, so I don't want to make any broad statements. It may or may not be possible within an IRA to do that with those.
Okay. Within
your IRA, you're saving your retirement outside of employment. It may be possible there, although quite honestly I'm not sure of the legal details. But if you've just got money to invest and it's outside of some formal retirement plan, then you can certainly go to the crowdfunding route.
A lot of the crowdfunding sites at the moment are raising equity. So it's very different. In that regard, it's very, very different from the REITs that are looking at much more at stabilized assets with income streams, right? They're not looking typically at value-add real estate.
Right. I mean, some REITs they do development and they do some value-add, but generally speaking, the majority of assets in REITs are going to be established properties that are cash flowing right now and are relatively low risk in terms of the spectrum of risk on the real estate market. The typical crowdfunding site or crowdfunding deal here, so it's almost hard to make generalizations. But you're right. Typically, crowdfunding is going for something with a little bit more risk on it. It's greenfield development of a new property or something like that, and then with higher potential return, higher potential risk as well.
Exactly right. So you're still going for yield, but look, a lot of what I hear is that people tend to orient towards the highest return options on the crowdfunding sites, which whether you believe it or not is the highest risk, right?
Well, you can't forget the risk part. I mean, just because they say the target return is 20% or whatever, right, might have to be picked out of the air. I mean, there's a reason why the potential return is that high. I think a good lesson for all investors, not just in real estate, but in anything, is whenever an investment has a target on it, a target return. I think a good lesson for all investors, not just in real estate, but in anything, is, whenever an investment has a target on it, a target return of say 20% or 15% or whatever, take out the word target and just put in potential. Like you could make that much money. If everything goes right, you could make that much money. And the higher that number is, the more chance you will not make that much money.
Exactly right. And so this is when people ask, what is why is crowdfunding any different from a REIT? It's, in large part, so let's just think that through. So in large part, it's because of scale, in part, right? That these
part
REITs
of it is scale, yeah. I mean, you can, depending, again, every crowdfunding deal is different. You could get some diversification by investing in multiple crowdfunding deals. Put $5,000 in
20 deals, whatever.
20 different
right?
deals or whatever. It would be hard to match the diversification in a REIT, but still, I mean, you could do it. And another difference is, I mean, if you're looking to make a lot of money quickly, I mean, the REIT market's probably not the place to go. I mean, you could happen to get lucky, but it's the same with the stock market in general. You could happen to buy it and have it go up 10% the next day, but chances are it's not going to. Crowdfunding deals tend to be a little bit higher risk. You're sort of getting in on the bottom floor, and I guess that's a real estate way of saying it, on a lot of these deals. So there's more potential return, but these deals may be higher risk. But again, there's such variation in crowdfunding deals. I mean, there's also a lot of debt crowdfunding deals where people are not raising equity dollars, but they're raising money and they're going to pay you back basically in the form of a loan. So the details differ wildly in terms of from deal to deal in the crowdfunding world, but generally speaking, they're probably higher risk, higher potential return investments because of the nature of the real estate that they're looking at. And then there's liquidity. REITs are liquid. Crowdfunding, because you're directly investing in actual real estate, it's not going to be as liquid as REITs are. But then
it's not liquid at all. It depends which sites you look at. But basically, you're investing in a deal, and you're in it for good or bad, whether it performs or not.
Right. So your money's locked up. But again, there's as we said before with REITs, the liquidity is a double-edged sword. You've got the liquidity, but you're also exposed to volatility because they're affected not just by real estate, but also by what's going on in the stock market. So there's no one thing I've learned with the real estate market in general and all the different ways to access it is there's no way to say, oh, this is the best way to do it. I mean, REITs have a lot of advantages. Direct investing has a lot of advantages, and sometimes the advantages, in other cases, best to use a little bit of both.
As a real estate guy, what are the key daily habits that you have that make you and your business or daily routine successful?
Well, assuming that I'm successful, I would say the thing I've learned that's important to do is to, no matter how many deadlines and projects you have due, and everybody's days typically consumed with meeting the next deadline, kind of trying to make time to think about things in a big picture way. So set aside some time, and some days it's hard to do, and some days you can't. But set aside some time just to think about the big picture. I mean, if you talk to very successful people in the industry, they know the real estate inside and out. They know the deals. They can crunch the numbers. They know exactly what their IRR is and all that kind of stuff. But they also know what's going on with the economy in Europe. They know what's going on in politics. They know what's happening in Australia, et cetera, et cetera. So just put aside the big picture outside of the industry.
Okay, question number 2. What has been the hardest lesson you have learned in real estate?
I don't know if this is a real estate thing in particular, but I think the hardest lesson I've learned in general is that there is always somebody smarter than you out there. No matter how much you think you know a topic, there's someone out there that's smarter than you and knows it better. And the trick is to hitch your wagon to those people.
And number 3, if you could give one piece of advice to somebody who has not yet invested in real estate but is considering investing, what would it be?
So are we talking about sort of retail level investors, individuals?
Yeah, just somebody who feels like they want to have an investment in real estate in some way.
Yeah, I would think, and if I had advice, and actually I've had people ask me about this before, they'll say, hey, I've heard people get rich in real estate, what should I do? And I always say, well, yeah, there are people that get rich in real estate. And I always say, well, yeah, there are people that get rich in real estate. There's also people that lose their shirt in real estate and just never talk about it again. So you got to be careful. Not everybody gets rich, but I think diversification is key. I mean, if you're a sort of a long-term investor, real estate can be a great investment, but don't throw all of your retirement savings or all of your savings into one property or one investment. You got to figure out a way to be diversified in some sense, and that's advice that holds outside of real estate as well. I mean, nobody would take all of their money, or I don't think too many people, anyways. Hopefully, would take all of their money and invest it in one stock and just hope it goes up. You want a portfolio of stocks. Same sort of thing in real estate. Try to figure out a way to invest in multiple properties.
Well, lots of information there from Greg MacKinnon. What resonates the most for me is this idea that REITs are subject to the whims of the broader stock market and so differ from crowdfund real estate investing in that regard. There's a summary of today's conversation at the show notes for today's episode at the National Real Estate Forum.org website, nreforum.org/PREA, where you can also find a link to start receiving my CFRE News Digest that exclusively covers the crowdfund real estate space and nothing else. In the next podcast, I have the great pleasure of speaking to Chuck Schreiber, who is CEO and co-founder of KBS Direct. KBS is also a REIT, but one that is exploring crowdfund financing as its primary source. What makes KBS fascinating is that they provide access to downtown America office high-rises that, until now, have been completely out of reach of anyone but the wealthiest investors. Now you can invest as little as $10,000, where before this would have been unheard of for this particular asset class. Be sure to subscribe to the podcast series on whatever platform you use for podcasts at the National Real Estate Forum.org website, nreforum.org, and hitting any of the links that I have included a page. Thanks for tuning in, and thank you also to Greg MacKinnon of the Pension Real Estate Association for sharing your time with me today. Until next time, this is Dr. Adam Gower, signing off.